Hi, my name's Andy Russell. I'm the CEO of Wealthify, and the markets have been a little crazy at the moment. Month on month, week on week, they're going up and down, and we know it's very difficult for customers to see their plans follow that kind of same trajectory, particularly those who are new to investing. And I guess during these turbulent times, we know that communication is key. We've already sent out lots of emails and blogs talking about this market volatility. So today we thought we'd give a video log a try. And to help me, we have Colleen McHugh, Wealthify's CIO, and Kyle Cox, Wealthify's Deputy CIO. Between them, we've got many, many years of experience of going through both the ups and the downs of markets. So perfect people to take us through and answer some of our questions today. So I'm going to be posing some customer questions to them. Colleen, Kyle, good morning. You all right?
Yeah, morning. Thanks, Andy.
Morning, Andy. Very well, thanks.
Cool. Well, let's get cracking straight into the questions. So, Colleen, what's happening? What's happening out there?
Okay, it's not very pretty at the moment, and what we're seeing at the moment and over the last couple of weeks is really a culmination of the sell-off that we've seen in global markets, both equities and bonds, year to date. And in number terms, we are at the moment, with the exception of the FTSE 100, which is only down about 4%, other global indices like the S&P 500 in the US, for example, is down about 20%, the Nasdaq's down about 26%, and our own 250 here, the FTSE 250 is off, 26, 27%. Bonds haven't been spared either, and that's a really important point to make. Bonds are generally perceived to be, government bonds that is, are generally perceived to be the risk-free class. Some government bonds year to date are down 20%. Now, to put that into context in terms of portfolios, what does that mean? Well, if we look at the typical balanced portfolio, which historically over the years in most time frames has delivered about 7% annual returns, well, that particular portfolio mix at the moment is down about 20%. So in terms of why, the reason for the market angst at the moment is inflation, and inflation at 40-year levels. So double-digit inflation levels at the moment. And it's the reaction of central banks as they try to tackle inflation, i.e. raise interest rates. So what we've seen over the last couple of months is central banks raise interest rates quite aggressively, Andy, to try and deal with inflation. And a rising rate environment is just not good for equity markets. There are some unique things going on in the UK market, which if we have time, I might come back to in the moment. But there are a couple of other factors happening globally. Least we not forget the awful situation in Ukraine. Well, aside from the humanitarian impact, that has really forced up global energy prices, which has had quite a dramatic impact, specifically in Europe, but also the UK. We've also got a slowing situation in China. So take your pick right now. There's just a plethora of problems out there, which is causing market volatility.
And why underpinning quite a lot of that is the kind of inflationary environment around the world. Why does inflation impact equities, and then why are both equities and bonds reducing while inflation is going up?
It's the interest rate. It's how you deal with a rising interest rate environment, a rising inflation environment, which is raising interest rates. And we've had a situation, Andy, for the last since 2008 crisis, that interest rates have been historically low. And risk assets have gotten used to performing in such a benign environment. So you flip it around, interest rates go up, and it puts a lot of pressure on both bonds and equities. In terms of bonds, bond prices have a negative relationship with interest rates.
Yeah, okay. So interest rates going up means bonds go down, and I guess the unexpected increase in interest rates is impacting equities. There's quite a lot of uncertainties we're going into this as well.
Yeah, the unexpected nature, but also the level of which rates are being raised in such an aggressive manner.
Yeah, okay. Cool. Thank you, Colleen. Cal, one for you then. How have we responded to that at Wealthify?
I think we've been very active, increasing caution as the year's gone on. We've taken risk off the table actively to reduce volatility and mitigate against losses. I think, as the year's worn on, our outlook's become increasingly gloomy, and we've acted swiftly to protect against capital losses. So the recent decision in September, we reduced our share allocation in favor of cash. I think at a very high level, we took away from more vulnerable areas that we're exposed to, such as emerging markets and Asia Pac. Speaking again about our bond exposure going into 2022, bond prices were very high due to those ultra low interest rates coming out of the sort of COVID pandemic, and we've maintained our exposure to what's called low duration assets, or assets with shorter maturities that generally have a lower sensitivity to interest rate moves. But unfortunately, because of the rapid nature of the interest rate increases and readjustments upwards thereof, there haven't been many areas to hide. I think cash has been one of the areas to hide, and we certainly don't consider that a long-term investment. We have increased cash, but that's a move to mitigate against volatility. So I think in terms of the interest rates and the effect on bond prices, we must always remember that these things are cyclical. So they do change through the cycle. I think it's very important as investors, we remain patient and avoid those emotional decisions that can cause capital loss. So I think in that respect, we've also sought to mitigate against volatility through certain currency hedging. That's not always going to go your way, but we certainly have just tried to sort of dampen the volatility for our customers. And we'll continue to look for opportunities to reduce that volatility, protect against loss as the sort of uncertain outlook persists. But certainly on the other side of the coin, we'll also look for long-term investment opportunities where we do see panicked selling in the market, valuations that are, and prices, asset prices that are away from their sort of long-term intrinsic values. Those are opportunities. So while we have one eye on protecting capital, we also have the other eye on opportunistically buying assets at low prices for our customers.
Brilliant, thanks, Carl. So I guess it sounds like we're reducing the risk in the portfolios by reducing the proportion of equities, bringing in the duration of the bonds, and both managing risk, also bringing in volatility as well to try and keep the ups and downs of it a bit lower. You mentioned cash in there as well. Should I be in? If I'm a customer, should I be in cash right now?
Look, cash is a real asset class, and it's something we consider as part of our asset allocation.
Yes.
But from a longer term perspective, that's not where the growth of the portfolio is coming. If I just flip it back a moment, though, the current environment, the current turbulent environment, it's not a conducive environment for investors. Logically, we're all rational human beings, and logically, our intuition at the moment tells us to sell. And to sort of hide out in cash until markets calm down. This is known as loss aversion. So it's a very common phenomenon. It's a very common bias, a cognitive bias in investing, whereby we acutely feel the loss much more than we feel the joys of a gain, for example. So the problem at the moment is that if you sell right now, the loss that you potentially have in your portfolio, you're going to crystallize that loss, meaning that the loss that you see on paper now becomes a real loss. And that's not something that certainly at Wealthify that we would suggest you do, because at the end of the day, we hope that you are a long-term investor and you've got some, you've got a long-term objective in mind. So all I say, just to summarize there, is try and be aware that try to be aware of this sort of loss aversion bias that we all have inherently. Try not to act emotionally. Remember, it's all about time in the market. It's not timing of the markets. Markets move very, very quickly. And a quick example of that alone in the last month, we saw the September sell-off in markets. We saw S&P falling, for example, by about 9%. Mm-hmm. The couple of trading sessions alone in October saw that same market rally 5%. So often, more often than not, the market's best days are followed by its worst days. So just bear that in mind.
So I guess what should we expect, or what should our customers expect in the next few weeks, few months? What's coming up, guys?
Yes, I think that's the big question. You know, what's next in markets? There's incredible uncertainty out there, so there's really no way to sugarcoat it. We do expect more volatility in the markets, but certainly, you know, we don't have any claim on predicting what will happen over short-term periods. And really, what we try to do is focus on what we can control and what we can see. So we just know, from our experience, that anything can happen in markets. So we've had the crisis in Ukraine, we've had COVID-19, these black swan events, these sort of unknowns that come at you from any angle. So our goal is to certainly reduce the volatility in the plans, build the plans in a diversified way so that no one outcome can sort of throw them off course. We're considering a range of financial indicators, fundamental indicators, and trying, as I said, to assess the pricing of assets over the long term. So I think, as we've mentioned, inflation is the key aspect we're looking at now. Certainly, central banks are worried about the runaway nature of it, and trying to do everything they can to step in. I think the main worry for us is that inflation does become embedded. This is a key scenario that we are looking at, and potentially, you know, a big risk to the global economy. So hence we are underweight risk assets at the moment, but we do feel that because there are a number of scenarios in play at the moment, and I think this is essentially what's driving the uncertainty, is that we need to have quite a balanced approach, so that we are exposed to all of those outcomes in a balanced way. And that we don't get thrown off our long-term objectives by one particular market event.
Yeah, okay, so continued volatility in the near term. Colleen, any closing comments?
No, I mean, all I'd add, Andy, is, you know, growth is the norm. We need to be very mindful that what's going on at the moment is a particular situation, and you shouldn't extrapolate the current situation out into the future, because the future is unknown. But we will position the portfolios for growth, and that is what we expect over a longer time horizon. Yeah. I just sort of say, look, it's not a very nice environment at the moment. The Wealthify team who are managing your portfolios have many years of experience. This is my 4th bear market. Kyle, I think you're number 3 or possibly even 4. Hang tight. And what is it they say? It's always darkest before the dawn.
Well, indeed, and I think it's always helpful to make sure we have a team of experts looking over your investment portfolios. Thank you, Colleen. Thank you, Kyle. Hope people watching and listening to this, that this has been useful for you, and that it's given you a bit more information around what's happening in your plans and the volatility we're currently seeing in the market. If you've got any questions for us, we'll have an email address coming along the bottom, which you can send us your questions. We'll feed them into future vlogs that we do, and hopefully get a good two-way conversation going with our customers. Thank you very much, everybody, for today, and see you soon.